Welcome back to the Property Trio podcast. I'm Cate, and as always, I'm joined by Dave and Mike. Today, we're diving into a hot topic that's sure to have property investors sitting up and taking notes: the trends set to shape property investment in 2025.
With 2024 almost behind us, we're here to give our listeners a glimpse into what's coming next, aren't we, Mike?
Yeah, well, we're not doing our 2025 predictions just yet, but we are thinking about, well, what's going to move, what's going to shift the sand, what are the property trends? And we'll try and keep it fun and light and yeah, just, I suppose, cast the spotlight on where we think the movements are going to be.
All right, well, let's get into it. Here are the key trends to watch in 2025. Let's tackle the first segment: interest rate changes and buyer behaviour. So if we start with this big one, interest rates, after a roller coaster ride over the last few years, the RBA's decisions in 2025 could dramatically affect property buyers.
That's right, Cate, exactly. So if you've been following the financial markets, they're currently pricing in a potential interest rate cut. Well, it's actually in the first half of the year. So this aligns with predictions that inflation will stabilise and economic growth will slow slightly, making a rate cut feasible. Now, I've actually done a little bit of my own research for this part. So just recently, the jobless rate fell from 4.1 to 3.9% in November. So that defied expectations. It was expected a 0.1% rate rise. So this is pretty unusual for, unemployment to actually fall when it's expected to rise, particularly with where interest rates have been sitting. So that sort of shook the market and expectations for what would happen with rates in the new year. But look, just as of the 19th of December, the trading day, so the ASX RBA RateTracker was actually 73% prediction likelihood that rates would fall in February. Now that's also sort of rebounded a bit because of the fact that the change to the RBA board and having the people who have been brought in, a couple of them have been calling for rate rises for a fair bit of this year. So it's actually more about what's happened there in terms of why it's actually rebounded a bit again for February to have a fairly strong chance of rates to fall. But at the moment, the markets are pricing in that there will be a rate fully priced for a reduction by April now. I've got some other... Yeah.
I can't work out whether we've got some dramatic changes in front of us or whether it's all a bit fickle, because we've seen the rate tracker jump around a little bit. But this month, if anyone's keeping an eye on the RBA rate tracker, it's a really easy chart to digest. It's been pretty consistent at that 73% that they're predicting a rate cut at the next meeting, which is just astounding considering how long we've been steady at the same rate.
I always take a keen interest when we're talking about rate cuts or rises in an election year. I think the election has to be by like May 17th or something like that. So the timing's going to be really, really interesting. And I've already seen some of the political advertising on TV. So it's already sort of begun, but they're kind of like, no one really cares at Christmas. So we'll let that go through. But you can just imagine the economic management stuff if they do get a cut. If it doesn't happen, then Liberal will talk about, overseeing this cost of living crisis. But, when it comes to property, that's the big one, really. That's the one that we're all talking about in 2025, because we know it'll make some difference. I mean, at the very least, it'll lower borrowing costs, and it could bring a new wave of buyers into the markets. But it's not just buyers; it can also impact, the investors that are holding on just by reducing their holding costs and lead them to think, okay, well maybe I'll spend some more money. That could feed into inflation, or maybe I'll look to withdraw some equity and go again. So it'll be interesting to see what happens.
It's interesting to think about the various buyer types across the market that will be stimulated to do something or to not do something by a potential rate cut. And when I say not do something, anyone that might have earmarked a property for sale because they're feeling the pinch, that could take the pressure off. Anyone who was waiting for the right time to do a bit of an upgrade to a property, a rate cut will make an enormous difference for an investor, because in most cases, investors have not only their investment property, but an owner-occupied property too. So they've got two sets or more sets of mortgage repayments. So, yeah, it could be very interesting if it's as early as Feb. And my thinking around this is that the sentiment associated with what could happen with a rate cut will drive buyers back, not necessarily them sitting there doing their personal cash flows and saying, now's actually a great time. They'll be looking at the clock thinking, how do I beat the hordes? Because we all remember how it felt in a really tough seller's market. In Melbourne, it was 2021 when we had those crazy conditions, but plenty of capital cities and other cities have experienced those conditions this year, and it makes buying really hard.
Yeah, look, I think it's certainly going to stimulate the property market across the country, and I think it'll reignite the Melbourne property market and Sydney property markets that have been flat, and possibly Hobart as well across 2025. I think probably the real growth will come in 2026, to be honest, once the FOMO really kicks in towards the second half of the year. So I think it'll be a slow burn, but I think the early movers will get the biggest bang for buck from their purchases in the first half of next year, particularly after the rates start to drop. And most predictions are that they'll fall by around 1%. So 0.75 to 1%, so 3 to 4, 0.25% falls over that period.
Would be an incredible change for people. I'm not so sure we'll see that happen quickly. I think we've been so steady at the helm. It would shock me if we had quick succession rate cuts, because they've been very mindful of steering this ship really carefully, but it would certainly make a huge difference. And I think the segmentation of the market will be a surprise to a lot of people. As we know, the higher priced properties have come off the hardest because getting your hands on those dollars is a lot harder. And it's been the lower quartiles that have held firm or performed. And I think we'll see a real change if we see rate cuts early next year. Those higher priced properties, people will dig deep and go really hard for them, because they know how special and scarce they are in some neighbourhoods.
Yeah. And we know as soon as you see the upper quartile moving the fastest, it's usually the beginning of a run for a market, because usually the upper quartile leads the way on the way up and falls the most on the way down.
Yep, so true. It's a great litmus test, isn't it?
And we're leaving an environment where I'm talking to, commercial buyers agents that are doing, big transactions, 10 mil plus, and the investors are just kind of thinking, the risk reward ratio just isn't there, because my private banking connections have me getting, 5% return or 5.5% return. You're talking about property, the appetite just kind of isn't there. But it'll be interesting, and it just kind of makes me think about those little graphs where you have the bell curve of the early adopters. There'll be certain people that are wanting to get in and around the sentiment when there is an expectation of a cut. Those people will be wanting to get in, but the market seems to be different to what it was 10 or 15 years ago. There is much more of a palpable herd mentality, and I think just a number of people leaping into a market is likely to be a self-fulfilling prophecy for that as well. People love to see green shoots, and they'll jump in, and I feel like a lot of them are very active on that back end of the bell curve, and I think that's where we might see some people getting into trouble in some of those really heated markets like Brisbane, Adelaide and Perth. If you're a little bit late to some of those, especially ones like Perth, I sit still for more than a decade.
Yeah, it's a really good point, Mike. I'd say demand will surge in suburban and regional areas, especially among first home buyers who can finally afford to enter the market. A price recovery might also attract overseas investors if conditions stabilise globally.
Yeah, and if they're allowed to transact without too many taxes and imposts, I mean, they've obviously been whacked a fair bit, and that's an interesting point, isn't it? Like it does kind of speak to some sort of inherent xenophobia, because a lot of people overstate the influence that overseas investors have on the Australian property market. And there's probably an expectation that some of the highest proportion of international investors are Chinese. But I think if you look in like fourth or fifth position after places like Canada and the UK, but it's just that perception, right?
Yeah, there's I think we all know that there's been quite a lot of xenophobia, and particularly in relation to property prices and the exclusion of local buyers, or the perceived exclusion. It'd be really interesting to delve into the numbers and to have a look at, it's probably another idea for a podcast actually, have a look at international buyers and what sort of purchasing activity there is around the globe, and how Australia sits within that.
Yeah. But I think people are also sceptical because it's so difficult to measure, particularly with cash purchases. And we're one of the last countries to adopt anti-money laundering laws to our real estate agencies, as well as barristers and some other areas. And so, we just don't know how much money is washing through residential property from overseas, but also criminal money as well. So I think people are skeptical, and I think I understand that perspective. I understand why people want some extra taxes if you're not an Australian citizen to buy properties in Australia. And I think
we've got some pretty horrible taxes.
Yeah, exactly.
It's about a balance, though, isn't it? I mean, there's probably people who have done this research, but anecdotally, I feel like we do know that overseas investors typically like to purchase new properties, which stimulates construction. And we are talking about this undersupply, and that goes on to the rental market, and that meets the needs of the demographics of people that are looking to rent is another question, because we've seen oversupply of rental property. I mean, we look back to the beginning of COVID, and even in Melbourne, places like South Bank, double-digit vacancy rate for a period of time. It seems crazy to talk about now, right? Like that was actually your time to bargain as a renter, and I can't see any good bargaining windows for renters anywhere in Australia in the next 12 months, unfortunately.
Yeah, I think you're right, Mike. Now, in the interest of time, I have a couple more segments to get through, so I'm going to move to segment 2, which is sustainable and energy efficient properties. We're seeing a massive shift towards energy efficient homes and eco-friendly living.
Yeah, look, I think investors are really starting to see the value in economically, I should say, environmentally sustainable properties. They're just more in demand from tenants. So obviously solar panels are the big one. Battery storage, I think we've still got a little bit of a way to go to get that tech to a more achievable price point. But of course, insulation, not just great for the planet, but they are becoming selling points for tenants and buyers. So, I mean, that could be a very positive thing.
Yeah, look, and let's not forget the government incentives that are out there. In 2025, we'd expect even more grants to be available, and green upgrades from the multiple, particularly state Labor governments across the country. I mean, we'll see what happens with the federal election. Depending on who gets into power, it's looking more and more likely it'll be a hung parliament, and Labor will have to piece something together with some crossbenchers. So that will be very interesting. But yeah, look, there's certainly, generally speaking, it's a win-win for landlords and tenants. I think it's still quite early days in terms of the green transition on residential properties. But we're going to see a lot more movement in this space over the next 5 to 10 years.
Yeah, agreed. But I do wonder about the upfront costs. And Mike, you've got a lot of data at your fingertips. Are investors being put off by the price tag?
I think they are still to some degree. And I mean, our data sort of just post-COVID says that a lot of investors are making less improvements to their properties straight after they purchase. It's almost halved from sort of mid-COVID. So yes, they are a little bit sensitive to that, but of course we've gone through a period where the rents have increased, and the Australian Taxation Office have kind of seen the value in these improvements. So things like water tanks, for example, they used to be considered capital improvements that would depreciate at 2.5%. Now they're plant and equipment items, and they'll depreciate a lot faster. And of course, system assets for solar, hot water systems have a longer effective life than electric and gas, for example. But I think the savvy investors will see it as a longer term play. I think utility bills are one of the things that is likely to stay quite sticky. As Dave mentions, we're not really in a position to hit the button and go completely green. There's a lot more costs in building out that infrastructure. And as we sort of wind down on some of the fossil fuel type generating assets, we can have some lumpy periods, and I think utility bills are going to stay high and they're going to feed into inflation for a little bit more. But lowering those utility bills has a value to tenants. Of course, you're going to see higher rental demand for those types of properties, and of course the deductions weigh into that as well. So the answer is, I suppose, yes, in that, because tenants are looking for ways to reduce their cost of living, and it can give a bit of a competitive advantage to landlords that have those types of properties.
Hey,
Yeah.
Mike, just sorry to jump in there, but just quickly, you mentioned how with water tanks you're able to claim depreciation earlier, by the sounds of it, a shorter period of time, which makes it potentially more valuable to put in water tanks. That was the point you were making?
Yes.
There?
Yeah.
Yeah. So the question I have for you, with being a QS, are you seeing that happen with other cleaner energy sort of items where the government is changing the approach to tax or depreciation so that there's extra incentives? Like, have you got some other examples? Is that a bit of a trend that you're seeing, or?
That was really a one-off. Changes that came to residential plant and equipment items that include the rainwater tanks, that came in the 1st of July 2019. So it's quite a few years ago now.
Yeah.
So we are certainly seeing a little bit more of that in the commercial space. If you think about where we get our effective lives, which is roughly sort of means how long an item will last, and that influences what its rate of depreciation is. We're seeing a little bit more in the commercial space, and there's about 180 pages of that tax legislation that has all the effective lives, and only really 4.5 pages of them are residential. But yeah, it was July 2019 that we saw rainwater tanks come in, and there's different categories for whether it's galvanized or polyethylene. So galvanized steel tanks at 25 years as opposed to the 40 years they were as a capital improvement, and the poly tanks are 15 years. So you're getting a lot better depreciation rate because of those.
Right. Yeah, that's interesting.
Great. Gosh, I love how you have all of this stuff on right at the top of your head, Mike. It's great. I've got a little summary here of the state and federal incentives for homeowners in 2025, just to run through these for our listeners. The federal small-scale renewable energy scheme provides credits for installing solar panels and water heaters. And New South Wales offers rebates on energy-efficient appliances. Yay. Victoria's Energy Upgrades program provides discounts on energy-saving products. And in the ACT, there's a zero-interest loan scheme for green home improvements. With programs like these, the financial barrier for homeowners to go green is certainly shrinking, isn't it?
Yeah, and I think these incentives will grow. I'm not sure where we are politically with our commitments to the Paris Accords and those sorts of things. I think we are struggling with figuring out a way to go forward as a nation. Obviously, those incentives are likely to to grow because they are meaningful, and so I think in tandem will be the demand for those energy efficient rentals, just really because energy is a big contributor to the household expenditure. So it is an opportunity, I think, for investors to lead the charge and put their investment properties ahead of other people who aren't making those investments.
Yeah, I wholeheartedly agree. Well, that's a wrap for energy. Let's go into our third segment, which is shifting demographics and housing demand. I love a good demographic story. Now, we've seen significant shifts in who's buying and renting properties. Dave, I'll get you to comment on this one.
Yeah, so absolutely. Let's so if we focus on the baby boomer population, which remains one of the largest demographic groups, so many boomers are now in their 70s and are increasingly looking to downsize from large family homes to smaller, low maintenance properties. So as of the 2021 Australian census, 21.5% of the population was made up of baby boomers. Now, that is down from 25% in the previous census, but still such a significant percentage of the population overall. 1 in 5, we are an ageing population. And what that census showed was 75% of them owned their homes outright. So they've got a lot of equity in there. There's no real pressure to sell necessarily, other than obviously frailty and less needing less room in your house. So the proportion of over 65s with a mortgage debt against their family home is only 9.6%. So it's very low. And much to probably the chagrin, particularly of our 80 to probably 18 to 40-year-olds, they've been the prime ones pushing up inflation recently. So in November 2024, CommSec released data showing how Australians aged over 60 were actually increasing their consumption spending by more than inflation over the past year, whereas pretty much all the rest of the population were reducing their spending. So, it sort of goes to that story of the wealth that the baby boomers have. But we did cover a lot of this sort of concept in episode 110 with pre-mic days, which was called, for our listeners, if you want to go back and take a listen, the baby boomer impact on real estate, why right-sizing needs policy intervention to free up supply.
That was a juicy one. I remember you and Pete did a lot of work for that one.
Yeah,
did we see into that one. Policy intervention after that recording? Because, of course, there were those downsizer incentives, right, where you could park proceeds in super for lower rates of tax and those sorts of things. Are you guys?
I don't know that the property planner, buyer and professor initiated that. I'd like to think so.
Look, certainly with the downsizing incentive, it's got broader and wider since that episode. So I think we were onto a trend, but that was already in place. Yeah.
That's a shame. But obviously they expanded it.
Back to the boomer activity. Mike, you have data at your fingertips. What's your thoughts?
Yeah, well, I mean, baby boomers and millennials are kind of like fighting for a percentage of the overall of Australia. They're sort of quite similar. I think millennials have only recently overtaken them. But it's interesting you mentioned the term right-sizing. What I've sort of got from an anecdotal data buyers agents that are active in those kind of what would you say, the retirement markets like the Central Coast of New South Wales and the Bowral and those Southern Highlands sorts of things, is that
where our Prime Minister's retiring to?
No, he's going...
It's Central Coast, isn't he?
Central Coast, yeah. Ettalong Beach, I think, actually did an estimate of the tax position on that investment property and his Dulwich Hill one. So I think... What is surprising to me is that they're not just looking for a smaller home. It actually still has to really specifically meet their needs, and they're probably much more pickier than a first home buyer would be because it's more of a foot in the market. Whereas these baby boomers, they're asset rich and they're cash poor. a cheaper property to bank some of the proceeds of just owning a property in whatever capital city or location that they have. But they do want to make sure that they've got that room for, people to stay over. They've got the space to host Christmas, even though this might represent 5 to 10% of the time that they use that property. They're not really that willing to compromise on something that can't sort of accommodate that sort of thing. So I'm finding that quite interesting.
Yeah, I think they're house proud, aren't they? And they've built, a lot of them have built a successful life. They're sort of at their wealthiest period in terms of net wealth, maybe not income, but they've obviously freed up a lot of their overheads. No longer, probably kids are now self-reliant. So, they want to enjoy their lives, and they want to live in a nice home. They feel like they've worked hard their whole lives to do that. And so, you often see they're right sizing. The price tag is very similar to the house, the large sprawling house that they've sold. Particularly if they're getting new townhouses.
I agree. It's not necessarily a financial move to free up capital. And to your point, Mike, I do anecdotally, I see people struggling with how small could they go, and they're thinking about all kinds of pressures that maybe their parents wouldn't have had to think about in terms of kids that stay home longer. We've got higher separation and divorce rates. We've got more shared parenting responsibilities. And so you've got these grandparents that are saying, well, what about when we are looking after the kidlings, or what about when one of our kids needs to return home? And so there's that, they're grappling with making sure that they preserve, at least a bedroom or more sizable living space so that they can continue to look after their family. And like I said, it's something that their parents didn't have to deal with to quite the same degree.
Yeah, look, I find it's actually often the second right sizing when they're becoming much less physically able that they scale back further. And that might be making sure, like if they did opt for a townhouse or a 2-story property, it becomes single story, much less space, much less willing to be hosting Christmas and those kinds of things. They're the realities that start to kick in as you get probably more into your 70s and 80s.
Yeah, you're right. I think
absolutely
there is
agree.
Compromise too much on space, and depending on where they go, I mean, if they go from Sydney to the Southern Highlands, you can certainly find places of a similar price that maybe have a better view or a better location, and amenities are important. But there are certainly baby boomers that are looking to move out of those congested areas to places where they might get a 20% or a 10% reduction on prices for the sorts of things that they're looking at, and then they can kind of bank that. And then you do have some ones that are just wanting to be actually closer to the action and quite happy to have a smaller property, just not something that's a multi-story with lifts. It's more of a low set sort of property with accessibility. And I think the government does really need to lean into that where it happens, because the quintessential idea of the little old lady in the 4-bedroom home is not 100%. I do feel like we need to take advantage of putting people into the locations that are beneficial for them, and trying to turn that household formation rate, the heat on that up a little bit. Like we actually saw a recent reduction in the national vacancy rates, and the commentary around that was that that's really just because people are moving in together a little bit more than they have been, other than it's not like there's less pressure on the market. It's just people are adjusting their behaviour, and that's feeding its way into demand.
Yeah. And look, that's why I love how they've expanded the downsizing contribution into super to make it easier, be able to put more money in, you and your spouse to both be able to put more money in. I think any of those sort of incentives where we can encourage and make it financially beneficial to baby boomers or, anyone in that retirement age to be able to sell a property and be able to put it into super, or any other benefits we can think of to free up stock for, those younger to be able to buy at a better price because it increases supply, I think is a positive policy move.
Yeah, indeed. So, overall, summing up things, location and functionality are key to tapping into this older demographic, and understanding what doesn't work can be just as important as knowing what does.
Look,
All
we could
right.
do a whole episode on that topic, which we have previously.
Yeah, it was fun, that one.
Yeah.
Well, that leads me to segment 4, emerging hotspots for growth. Let's talk about location. Where should investors focus their attention in 2025, Dave?
Well, look, regional areas have had a little bit of a renaissance period since COVID, or quite a strong one, really. And one major project to watch is the Inland Rail. So this massive infrastructure project is connecting regional centres with major cities, making these areas more accessible and boosting their economic potential.
Yeah, the Inland Rail, I think, is a big one. It's got a little bit of press, but not as much as I think it deserves. And we're talking about a $15 billion project that covers 1,700 kilometres. It's going to connect Brisbane to Melbourne. Obviously, it's not really a commuter thing. It's more of a widgets thing. But it's going to run through some pretty key locations like Toowoomba, like Parkes and like Albury. And I think a lot of people have been zeroing in on the Albury-Wodonga market partially for that reason. Obviously, it's a big centre as well, and it's not a million miles away from Melbourne. And it's I remember growing up in country New South Wales, if we went to Wagga or Albury, that was sort of like going to the city for us. And there's lots of places like that around the country where, like, Dubbo is kind of the city of the central west of New South Wales. But that's just why I'm quite interested in that, is just the job creation potential of projects like that. And we know that where there are employment prospects and rising incomes, that's a really good precursor and a correlation for price growth.
So, what does it mean for property investors, Mike?
Well, I think it's just all about the economic growth that we get on that connectivity and the jobs that we'll see that are in and around that. And it's not just the rail stuff, is it, Dave? Like, there's quite a lot more that goes into it than just the ballast and the actual rail and the signalling stuff.
Yeah, look, I think, as you've touched on, there's better economic growth. Connectivity comes between those locations. You're going to get jobs in logistics, warehousing, and regional infrastructure, which will boost demand for housing. With towns along the corridor, they will then likely to become more attractive for families, businesses, and retirees. So investors should look at well-located properties with the right attributes, as always, such as land to asset ratio, logical floor plans, good natural light, location in the street, and orientation in these areas. But look, it also should be noted, not all cities have given approval yet, and that's actually blown out the cost. So the latest estimates have actually jumped up to $30 billion, Mike, which probably won't surprise you or any of us, that there's been a bit of a blowout in the expectations. Oh. And one example of a major city that it's meant to run through that is pushing back on it is Wagga Wagga. So basically, the problem with Wagga Wagga... So first of all, to put some perspective in this for people, the length of some of these trains are going to be 1.8 kilometres long. Okay. So some could have 20 towns could have, or some days could have 20 trains a day go through their towns. And that with Wagga Wagga, where it's planning to cut through is a train line that impacts the city. And it's actually just the other side of the primary hospital. And that hospital services 250,000 people through the Riverina region. So people are worried about things like how it could slow down ambulances and, people getting to the hospital, because the wait time when these long, lengthy trains go past are significant. So if you have 10 or 20 of them going through on any given day, it's a real impact to local traffic and locals, and specifically in this example, people trying to get to a hospital. So, there's always the devil in the detail with these major projects. And, you don't want to be someone to pour cold water on these things, because we want this kind of progress, don't we? But it's got to be done properly. And, because I think something like 2/3 of the train line already exists. So they're trying to save cost there by, just only having to produce about 1/3 new train line. But then you come up with challenges like this if you're trying to use what already exists.
Yeah.
There's an interesting article that came out in October from the AFR, and the title was "Why 31 billion will not be enough to build inland rail." So you say we don't want to pour cold water in it. The AFR are giving it a red hot go. Yeah. But I mean, like, whenever we get an estimate of a project from the government, it's going to be delivered by this time and it's going to cost this month. I mean, you've always got to take that with a grain of salt. Like, have you seen all of those signs they put up, with the freeway works, expected delivery October 2024, and you're looking at it and it's November and they're miles away. Like, it just happens all the time.
Totally. Yeah. I think on our Westgate project here, they had 2022 for a while, and I don't know if you've been reading the news from up in Newcastle, Mike, but we had a problem about where we would dump the dirt that they dredged out to create the tunnel, and that feud went on for a long time, and it put our project back significantly. It's still not open.
Well, I always remember, I think it was the Google CEO who said, have a project, then times the original estimated time and cost by 3, and then you're likely to be close.
That's frightening.
Yes, unless you let the private sector handle it, but that's not going to happen for this particular one. But look, the reason why I sort of flagged this one, it's not necessarily a hotspot pick, it's a long-term growth story, and I think infrastructure projects like this, they will bring job opportunities. There's a certain amount that comes with the construction, then there's the maintenance, and then there's the economic hubs that can sustain growth for a number of decades. So that's kind of my interest in projects like that. That's not the only big infrastructure project that we've got going on. There's all sorts of things around the planning changes that we've certainly seen in New South Wales around these rail hubs, and we talked about that from a Victorian perspective a couple of episodes as well. We've got some height restrictions. We're going to see some development around these main kind of hubs. So I think infrastructure is going to be something to watch in 2025 and beyond. Cate, what do you think infrastructure when you think about its influence on property?
I'm a big fan of trains. I've always maintained that. But we're talking about a different kind of train here. You've absolutely nailed it in terms of it being more freight related. But, connectivity means everything. When we've seen in the past, the small little townships that have then been links on the way to a big city, and all of a sudden you've got the freeway bypass that goes around it and it becomes a ghost town. This is the opposite of that. It's really linking some large regions with some very busy and dominant capital cities. I think it can only spell one thing, and we all know that we've got a government that is supporting new arrivals, spreading out, and not just targeting the capital cities. We've got incentives in terms of visas that are being granted and jobs that are on offer. We really are trying to attract people to our regions. So I think it's a huge positive for the big regions.
Yeah. Do you think there'll be some winners from the Inland Rail project across some of those country towns, wouldn't you?
I absolutely do.
It's the investors, they've got to be discerning, don't they? It's not just pick any town and it automatically it's going to be a great result.
Yeah, for sure. It comes down to more than just rail. But rail infrastructure means so much. And as you said, Mike, it creates immediate jobs and activity as well. And then when you get activity, you get more people coming to an area, you get more construction to house all of these workers. And it does, it can overstimulate a market sometimes at the start, and it can create imbalances here, there and everywhere. We've seen that before with major projects when there's not been enough housing for renters and buyers. But I think all up, You've coined a phrase here, follow the rail and follow the growth. I'm not sure I entirely believe in that. It's a very simplistic way of looking at it, but I think that anyone who's interested in focusing on some of these cities, capital and regional, that could be poised for growth, it's definitely one key growth driver. Now, we're on to our last segment, and this has been a long podcast recording, so I hope our listeners aren't going to get too cranky with this for having a long one. The role of technology in property investment. So let's talk tech. How is technology shaping property investment, Mike?
Well, I mean, there's a lot of talk and there's a lot of fluff. I think AI tools certainly are already being used to help investors analyze markets faster. And if you do have access to big data, you can feed that into large language models and get some interesting interrogation on that. I think platforms like fractional investing are making property a little bit more accessible. I mean, that's not a new tech that came out a couple of years ago. I'm surprised to see that hasn't gone any further. And in some respects, I'm sort of sick of talking about AI and property, but I do believe it might not necessarily be 2025 that we see it really kind of finding its way. And the pace of change is so rapid that I wouldn't want to rule out something big happening in the next 12 months.
Yeah, look, I think software ultimately in AI and technology is going to keep playing a larger and larger role across all forms of property investment, financial analysis, cash flow management, and it's already weaving its way into how businesses like ours operate. I mean, I reckon like 7 or 8 years ago, we probably had 1 or 2 pieces of software that we paid for external use to run our business. And now it's probably at 15 to 20 different pieces of software that we pay a monthly fee to access to be able to run our business. And that's going to flow through to consumers. Consumers will start using more and more software. I think we're really at the early stages of this trend. And I think it'll probably it'll continue to build more for people managing their own finances and working out cash flow, what's the right property purchase for them, working out loan to value ratios, equities, modeling their returns. I think that's the most obvious place. I think it can also, it's early days for actually predicting what's going to happen in suburbs and with certain properties and that sort of thing. But I think it's still early days, and there's a lot to play out in that space, and a lot of opportunity.
Do you think technology is making it easier to invest?
I think so. I mean, even basic technology like the ability to view properties remotely, whether it's Google Earth or Google Satellite, or even just the domain and those sorts of things. I mean, in our own data, we saw the average distance people buying from where they invest, starting at 293 kilometres in 2019 all the way to 1,500 kilometres, which is sort of more about the rise of Perth. But even before Perth took off, we saw a lot of people during COVID looking around the country for their investment, rather than that sort of stereotypical idea of it being around the corner from where they live. But there's too many limitations for the tools at the moment. Like the AI tools can analyze the trends, and they can see the pressure building in a market with days on market or inventory levels, but they don't have that nuance of the local market knowledge. And I think that there are certain things that you can't put into a model and understand exactly how it's going to happen. For example, the global pandemic, we saw the big 4 banks saying a 30% cut in live their whole lives in economic models, and that was a giant failure.
Was indeed. And back to the local market knowledge nuance, that's a very hard thing for an algorithm to pick up, because it's dynamic as well. We don't know what's changing, and physically inspecting a property, I think, is an absolute must do, and I'll maintain that.
Yeah, well, look, I think it's a really good point, Cate, because I've said this before, but like if the technology gets so good, it can predict what's going to happen, then what's going to happen changes. So it can never be perfect because you're dealing with humans at the end of those decisions and those predictions. So it's always evolving.
Yeah, so true. It is an exciting time for tech-savvy investors, but a balanced approach is absolutely critical. You can use the tools, but you just can't skip the groundwork. Now, on that note, what a corker of an episode. Our top trends to watch in 2025. We've come to the end of our show. So whether it's interest rates, sustainability, the latest tech, there's plenty to think about as we head into the new year.
And as always, we'd love to hear from you. So what trends are you watching? Send us through your thoughts and questions. And we look forward to hearing those from you and hopefully throwing a few of those into our listener question episodes in 2025.
Yeah, absolutely. And if you jump on social media, you can follow us for more insights, and it's a good way to send through some questions as well, or just get a little bit of a laugh or two, and maybe some of the weird stuff we're up to in the holidays. But happy investing for everyone in 2025 regardless.
Oh, thanks for listening to the Property Trio podcast, and we'll see you next time.
See you later.
See you guys.